Welcome to the live stream. This is Sebastian Boyer, the approved guy. And on this video, I am going to be introducing you to the whole life strategy, the whole life insurance saving strategy, and my new website, which is just that, wholelifesavingstrategy.com. We're going to review that, go over the points of this strategy. I'm going to try to go through it slowly and give an opportunity for anyone who might be on their lunch break on a Monday at 2 p.m. Eastern time to jump on, make some comments. Hopefully we can get some traction. I know that this is brand new, so I don't have high expectations as far as an early audience, but would love to be able to interact. So with that said, I'm going to go ahead and dive right in. And so this is just to show you the brand. This is the whole life saving strategy logo. And I'm going to be working around this to teach about the whole life saving strategy and using this as a premise to make it really easy for you guys to submit questions, or if you want to see an illustration of what that looks like for you, then you'll see a link in the description below to do that. But without further ado, let's go right to the website and start going through what this is all about, the whole life saving strategy. All right, here we are at the main website, and you can visit this website. It's wholelifesavingstrategy.com, and it's a better way to save. Okay, because what are your savings options right now? You could put money in a savings account at the bank, and even if you can get 2 or 3% growth on that savings account, you're going to pay taxes on that growth. And unfortunately, what's going to happen is if there was ever any litigation or creditors or anyone coming after you for money, your money is at risk. It's exposed in that bank account. It is yes, FDIC insured, but that's like what? If the bank fails, you have protections. But other than that, your money in the bank account, number one, it's very hard if you can't even find a bank account that's going to give you any kind of interest. You're going to pay taxes on that growth. And number two, your money is not safe. It's not protected. And then the third thing is, if you're using your bank account as a savings vehicle, then it's very easy for you to access that money and spend it on a whim. Now, you should have different accounts. Obviously, you need to have your spending account where you're going to be able to spend for your daily expenses, your gas, your food, your living and daily expenses. You need to have access to that to spend quickly. But if you create an emergency fund or an opportunity fund, which is really what we're talking about here with a whole life insurance saving strategy, is to leverage a whole life insurance policy as a savings account, not as an investment account or an investment opportunity, but as a way to save your money and allow it to grow with compound interest growth, but then have access to it. Now, as an emergency fund or an opportunity fund, you want to be able to, because it's in a whole life insurance policy, you have access to it, but it's not instant access, like same day within 20 seconds access. It's going to take a day or two to process the request for the payment, and maybe a couple days before that payment or that money from your savings inside of the policy is deposited or transferred to your bank account for you to use it, which is a good thing. Because if you're presented with an opportunity, or if your emergency fund is where you're storing what you're using this for, to store your income for that emergency, you don't necessarily want to have that money available in an account that you can spend quickly and easily based off of an emotion. Maybe you're out in the world at the mall shopping, or maybe you're looking at a vehicle, or you're looking at something. An opportunity presents itself and you get extremely excited and emotional about it. Well, how about instead of jumping at that moment and making a rash decision, having a function or feature in place that forces you to wait a couple days before you spend that money, before you make that transfer. You should always sleep on it, right? It's always good to wait at least 24 hours before making a big decision. And you should, before making that decision, you should consult with, at least your spouse or someone who's close to you. That's one person. And then second would be someone that is a mentor, someone who is reliable in terms of finances and making good decisions. And then you want to do some additional research before making rash decisions. And so if your money is stored inside of a whole life insurance savings strategy account, which we're going to go over now, you have access to it, but there's a little delay. So that emergency fund is not going to get depleted, right? That opportunity fund is not going to get depleted because you got excited and emotional, made a rash decision, and now you can't get your money back. It's too late. You sent that wire transfer, you made that purchase, and there's no refund. So if anything, it's good that there's a slight delay in getting access to the money, but you do have access, and you will be able to access it fairly quickly within I'd say 5 to 7 business days to get access to your funds. Okay, so I believe this is truly a better way to save money. All right, it's your emergency fund, it's an opportunity fund, it's a retirement fund, and it's your legacy. Right? You can click the link right there to schedule for an illustration if you'd like to see what that looks like. So what are some of the common uses of this type of policy or this strategy? One of those uses is going to be, it's an emergency fund. So let's talk about an emergency fund. An emergency fund is a fund that you have in place, and most people talk about it only in the case of if you were to lose your income. So if you lost income, your job or income stopped flowing, what they say is you should have at least 6 months of an emergency fund. I don't think 6 months is enough. I think you should have 12 months. You can start with 6, but your goal should be to have 12 months of an emergency fund in place to replace your income. So that's 1 year of income saved in account just for that purpose as an emergency fund. You want to have access to it. Now that money should not be in an investment account, because an investment account is volatile. So if your money is in the stock market, in crypto, or in any vehicle where you're going to see fluctuations in the performance of that account, well, that's not a safe place to store your money. We don't want to put it in a savings account either, because that's not going to get, there's no growth in there, and we can do much better in terms of overall functionality, features, and benefits using a whole life policy. But again, this is not an investment account, it's a savings account. But it is going to give you 3%, 2 to 4%, depending on the insurance carrier. You're going to get a 2 to 4% guaranteed compound interest growth. All right, that is a guarantee. All right, there is no risk in a guarantee. Okay, so your money is safe and secure. Now, with a major mutual company, you are also going to receive dividends based on the performance of that business or of that insurance company, because you're partnering with the insurance company as a client. Since they don't have any shareholders, you become a shareholder and you also receive dividends. So now not only are you getting your guaranteed compound interest, but you're also getting dividends. But the dividends are a bonus. We want to make decisions for things like an emergency fund and an opportunity fund and a retirement fund based off of guarantees, not off of possibilities and potentials, because it's very easy for a life insurance agent to illustrate the potential of an insurance policy, right? However, if that insurance carrier with certain products are investing your money in the market and you're expecting returns on those investments, well, that is just as volatile as going directly and investing your money in the market, which there's nothing wrong with. You should have some money going into investments that are going to give you large returns, because that's how you're going to grow wealth, whether it's in the stock market, in the crypto space, if you're investing in real estate assets, if you're doing any type of business that is generating revenue and income. You want to be able to have access to your money in an emergency fund, opportunity fund, and retirement fund, where it's not in an account that's volatile, where that account is not going to be at risk of the ups and downs of the market. So this is a place, this account that we're looking at right now, this whole life insurance savings strategy account, is a place where you can store money, and it is not going to be volatile. It's not going to be susceptible to the ups and downs of the market because you have guarantees. So this is a great place to have your emergency fund, and that money inside of this policy is protected from litigation in most states. So creditors, debt collectors, any lawsuits, they cannot come after the money, your savings inside of your life insurance policy. So it's a safe place to protect your money. Okay, so your emergency fund, generally speaking, should be 6 to 12 months of income replacement. But a real emergency is not necessarily going to be if you lost your income. A real emergency is if something happens where, let's say, you get in a car accident or you slip and fall and you injure yourself, where you're unable to not just work for a time being, but who knows, maybe for the rest of your life, right? Or you become ill or sick where you have you have the inability to earn income, right? Whether you're terminally ill or you're critically ill and you're unable to perform some basic living actions like feeding yourself, bathing yourself, moving from one place to another in your home. Life happens. Unfortunately, we cannot predict it. Those are emergencies, right? Your health insurance is not going to pay for in-home care in those events. It's not going to pay for more than what's covered by when you go to the doctor or if you have to have some type of surgery, etc. But what if inside of your life insurance policy, you have living benefits, which are an advance from the death benefit, which basically gives you the ability to receive an advance from the death benefit. So in the event that you're unable to care for yourself, what if you can get an advance from your death benefit? You don't have to pay it back. It's not a policy loan. So let's just say you had $1 million death benefit and you can get a $500,000 advance while you're alive. You're living now. You have not passed away. You're alive. And you're able to get that advance from the death benefit, which you don't pay back. That is an emergency fund. And that's not even touching your cash value. So you're not going to get that in a savings account. You're not going to get that in other investments. And that's what I think people seem to, forget about life insurance, is that you have a death benefit. And with the right insurance carrier, you can have living benefits, which is a true emergency fund, not just for income replacement, but for replacing or for helping you to live in the event of critical illness, terminal illness, or where you're unable to care for yourself, right? So that's something to consider and to keep in mind here for your emergency fund. So you can store your money in your vault inside of your life insurance policy. It's also an opportunity fund. An opportunity fund is a fund where if there is an opportunity for an investment, if there is an opportunity for you to invest in an asset, real estate asset, in a business, in the market, whatever the case is, you have a safe place where your money is stored and it's growing. So it's not just sitting there doing nothing. It's compounding interest but you can access that money now for that opportunity, right? Sometimes that could just be a bridge, maybe a down payment. Sometimes it could be the entire investment that you need for the opportunity. So what if you had an account that was safe and secure, that acts as your emergency fund, right? Not just for replacement of income, but in the event of something catastrophic in your life. But you can also store your opportunity fund in there. Now, you want to separate those two. You can have one policy that works as your emergency fund. And so if your income is $100,000 a year, that should be your goal, to store and save $100,000 of cash inside of your policy, right? And then you want to maybe double or triple that, so another 100 or another 200 saved in the policy, in the cash bucket, in the vault, so that you have that as your opportunity fund, because you don't want to pull from your emergency fund to use as your opportunity fund. Your emergency fund is your emergency fund. Your opportunity fund is your opportunity fund. So those are the two main uses or funds, right? Now from there, we can use this funds to pay off debt. Maybe I have a car loan and I want to get rid of that car loan and the interest rate. I can use a policy loan for my whole life insurance policy, borrow 20, 30, 50,000, pay off the car in full. And now instead of paying back the bank an interest rate to the bank, I'm paying back my policy loan and I have flexibility to pay it back. I'm going to pay interest back to the policy, yes, but I can, if I'm strategic with this, I may come out with a lower interest rate than what I was paying with the car loan, right? Or I give myself flexibility where I don't have to pay the premium in full every month. So if I'm having a bad quarter, I don't have that urgent, immediate need to make that payment. Now with policy loans, you should always pay the interest. Don't let that interest compound against you, right? But the principal is very flexible. So it gives me some flexibility. And again, I've transferred ownership of the debt from the bank to my insurance policy, and I'm giving myself more time, more flexibility to be able to pay that back and ultimately have more control. And that's the key, is control, right? So you can use your life insurance, whole life insurance saving strategy and the cash value to pay off debt, to consolidate debt, whether it be high interest rate credit cards or any high interest rate debt that you have. It could be a tool that you use to pay off your debt. It could be a tool you use for your kids' college savings funds. Most of the college savings programs that are out there are very rigid. You get taxed when you use those college savings funds, number one. Number two, a lot of them are very rigid in terms of where you use them and how you use them. And if you don't use them for their intended purpose, you lose them, because that's what they were designed for. And so if your child is not going to go to college, but maybe a trade school, or maybe they're not going to go to college or trade school, but they're going to start a business right out of college, or who knows, right? Not everyone has the same journey or destination. So what if you had a college savings fund for your child from the time they were born or from when they were really young for a very small amount that you can grow and save between $30 to $50 or $100,000 inside the cash bucket of that policy with compound interest growth year after year after year. By the time they're 18, 19, or 20, you have a lot of funds saved and you have total control and flexibility of how that money is going to be dispersed, right? Whether you need to buy them a car with it, or you're going to use it to pay for their rent, or you're going to use it to pay for the college tuition, for their books, whatever the case is. It could be a supplement to their college tuition, or it could be spent however you want to spend it. So the key is control, and that you're not going to pay taxes on that money when you borrow against it from the policy, and you have flexibility to pay that back over time. You're borrowing from your own savings and paying yourself back. So ultimately, you're not only using this once, but as you pay it back to yourself, you are now replenishing your policy, and you can leverage it and use it again and again and again, just like a line of credit, right? So that's the college savings fund. Business funding. So if you're a business owner and here we go, sorry. If you're a business owner and you have you need to invest in your business, whether you want to consolidate, expensive business debt, you can use your policy loan to fund your business. And I put out a video about a week or two about this, where you can use a third-party intermediary called PIGEON Loans, which basically drafts up a legal binding contract. So when you borrow the money from your policy personally, you can make a loan to your business and then use PIGEON Loans as the intermediary to document it. And then from there, when you pay back, when your business pays you back personally, you're going to be able to receive a tax deduction in your business for borrowing and paying back yourself. So you're literally um, leveraging the fact that you have a business and your policy loan, and you're going to help yourself offset the policy loan interest rate with the business's tax deductions when you borrow to the business. But what if you have your opportunity fund growing for your business? So when your business needs to expand or grow, or if you need a 10% deposit for an SBA loan, or you need to restructure some bad business debt, some high interest credit cards. Maybe you went for a round of 0% funding, and a good amount of the balance is still there after the 0% expires, and now the interest rates are at 15 to 25%. What if you could get a policy loan at 5 or 6% and transfer all that debt to your policy? That would be a very strategic way to leverage your cash value to transfer debt. And then again, with the Pigeon loan intermediary, you're making a loan from your personal, once you get the money from the policy, to the business, and then you can pay yourself back from the business and write off a portion of the interest. You can write that off as a tax deduction for the business, so that helps to offset the interest rate. So I mean, it just keeps getting better and better. So you can use it for home improvement. You can use your cash value in the savings vault for travel or vacation. You can use it for special events, big ticket items that come around once in a while, like a wedding or a special event. And then, of course, if you use your policy properly and wisely, you're going to be able to replenish it. And so later on in your retirement years, that cash value can act as a supplemental retirement income, right? Now, some people may think about surrendering some of the cash value. Now, if you surrender the cash value, you will be taxed on the surrendered portion. So I recommend, if more strategically to borrow against it, leverage it, pay the interest, and then pay back the principal, in your capacity. But you definitely want to have a plan to pay it back and treat yourself like a bank would treat you. But what if you had that extra 200,000-300,000 in the cash bucket of the policy, where you can borrow against it, or if you had to, you could surrender it for your supplemental retirement income. So should this be your only retirement strategy? No, definitely not, right? This is a supplement to your retirement. A tool that's much more aggressive and powerful for retirement is going to be an annuity, right? An indexed annuity is something that you can get guaranteed income from in retirement, and you couple that with your whole life policy that you use in your living years for the living benefits and for the cash value growth. Now you can have a very strong retirement plan. And of course, you're putting your money into your investments. You're going to continue to grow your business. So that's what this is about. Doing more than one thing at a time, having a diverse portfolio, but having that emergency fund and having that opportunity fund in a safe, secure place where you don't have to worry about it losing value. It's going to continue to grow in value, right? So really quick, just some of the benefits of the policy is going to be, you have guaranteed compound interest. The growth inside the policy is tax-free. As long as it stays in the policy, you borrow against it, it's tax-free. If you surrender it, then it's going to be taxable. And that's why it could be tax-free or deferred, because if you did surrender it, you would pay the taxes. It's liquid and accessible through policy loans, so you can borrow against it. So your funds are not in a product or a vehicle where you cannot access it, where you're going to end up paying penalties and fees. There are no penalties and there are no fees to borrow against your policy. Obviously, there is an interest rate on the policy loan. And again, we've talked about some strategies to offset that. It's protected by the death benefit. So what that means is that if the insurance policy, if the policy loan is not paid back in full before you pass away, then the insurance company will pay for the balance. They'll use your death benefit to pay off your policy loan. So it fulfills itself in the end. And so in the end, if you have a balance, your death benefit will pay for that, right? So if you had $1 million death benefit and a $10,000 balance, they'll just take that 10,000 out of the million before they distribute that to your beneficiaries, right? Um, so it's protected by the death benefit, right? It's protected from litigation. In most states, it is protected from litigation. So every state's different. We'd have to look at your state to let you know what type of protections you have. So your money stored inside of the policy would be protected in most states from any litigation. Um, Currency standard protection. This is crazy. So here's the thing. If you would have asked me, I don't know, 15 years ago, like if you would have told me this, I would have said, that's silly. You know, you're a conspiracy theorist. This would never happen. So what I'm talking about is, what if the government and the world changes the standard of currency from the standard that we're looking at now? So right now we're dealing with fiat as the standard of currency, right? The dollar, the US dollar is the standard that we're used to and that we're working with. But before that, there was a gold standard, right? So remember, the US dollar is a promissory note for its value in gold, right? So with the advent of cryptocurrency and the technology that is in place, there's a real possibility that the currency standard could shift to a different standard. Now, if that happens, you ask your bank, if there's a currency standard shift and my money's in my savings account at the bank, what happens to the value of my dollar? Does it shift or change to the value of gold? What is the value of that dollar inside your bank account? I could tell you this, inside of the insurance policy, it's protected. Whatever the standard changes to, whatever the currency standard shifts, whether it goes back to a gold standard or it goes to some type of crypto standard, which is a probability that could happen soon, your money is protected in terms of the currency standard. So again, I'm not a conspiracy theorist, but that is a real possibility that that's something that's going to happen potentially in the next 5, 10, 15 years. Some people believe it's going to happen sooner. So that's another protection. We talked about retirement income, generational wealth. The death benefit of a life insurance policy is going to be left to the next generation. That's the death benefit. It is highly unlikely that you're going to be able to earn more income in your life, in your span of life, than what you can purchase in a death benefit on a policy, because it doesn't matter what level of income you are at. If you're $100,000 a year earner or $1 million a year earner, right? Whatever your level of income, if you earn $1 billion a year, whatever your level of income, you can always buy more death benefit than what you can earn. And that death benefit is your generational legacy that gets left behind to the next generation, right? And if you structure it properly, you set up a trust, and you can make the trust the beneficiary, and then through your trust you can control exactly how your money is dispersed to the next generation. So your generational wealth is a huge factor to consider and to think about when it comes to this strategy, your whole life saving strategy, because that death benefit is going to be your generational play. And again, why do so many people downplay the value of the death benefit? Like it doesn't matter. Because why? Because they want you to invest your money with them. Financial advisors and whatnot want to control your money and put that into products that are going to earn them high commissions. And listen, I have no problem with anyone earning commissions. But if your emergency fund and your opportunity fund are in volatile vehicles and investments where you cannot get access to them, or they're going to go up, the value of them are going to go up and down based on the waves and currents of the market, then that is not a safe place for you to protect your liquid assets. As far as a savings account for your emergency fund and opportunity fund is concerned, right? Investments are investments. Separate that, okay? All right. And so finally, the living benefits we talked about, that's really going to be, the emergency fund that you could tap into that you don't have to pay back, which is the living benefits from the life insurance policy, right? So some of the key features we talked about is the cash value of the policy, um, inside of a properly designed and optimized dividend paying, high cash value whole life insurance policy is a cash vault, sometimes called paid up additions. There are guaranteed growth rates, and inside the policy, the growth is tax free, right? The death benefit of any life insurance policy is tax free to the beneficiaries. In this case, the death benefit is also used as collateral against any outstanding policy loans. The living benefits, these policies can include living benefits, which is an advance from the death benefit in the event of a critical or terminal or under certain medical conditions. And then your policy loan. The cash value in the policy is accessible as soon as it clears in the account, typically within 20 to 30 days of deposit. That's very important, because there are products out there that insurance agents are selling where they're telling you to use these products as your saving strategy, but really they're pitching it as an investment strategy, and that you can still have access to the cash. But it's going to take 3, 5, 10, 15 years for you to be able to get access to that cash. With a whole life insurance policy with a major mutual properly designed, you can get access to the cash value. And I'm not talking about pennies. I'm talking about 75 to 90% of the cash value, which is the premium. If you put in 100,000, you can literally get access to 75 to 90,000 of your cash value within the first 20 to 30 days. As soon as that money is deposited and clears in your policy, you'll have access to it. The insurance carriers allow policies loans up to 90%. So you can borrow up to 90% of the cash value from your policy at any given time. Because the funds are borrowed against the cash value and not from it. This is amazing. Your money never leaves the policy, which means it is not taxable, and the growth of the cash value is uninterrupted. And with certain insurance carriers, you're not every insurance carrier is the same. So some insurance carriers have what's called a direct recognition, and some have a non-direct recognition policy loan. There's advantages to both. You have to look at what makes sense for you. But generally speaking, a non-direct recognition, you continue to receive dividends on the cash value in the policy, which has uninterrupted compound interest growth. So even though you've borrowed money from the policy, or against it, I should say, and you're using that in your business and in your investments, your insurance policy, the cash value continues to grow compound interest because it never left the policy. The policy loan is separate from the funds in the policy. They're using that as collateral, and it's protected by the death benefit. Amazing. Policy loans do have interest, but if managed properly with certain strategies, as we've discussed, the interest can be minimal and will not impact your policy performance. All right. So what about term life insurance? When is final expense the right solution? What about business use? What about retirement income? How about estate planning? If on the website, you can continue to learn more and read about term life insurance and when I recommend using that. And I always recommend a convertible term life insurance policy, because you have the option to convert it to a whole life policy versus a term life without that convertible option. If you outlive it, 100% of your premium is profit for the insurance company, and it's a 100% loss for you. And unfortunately, most people outlive their term policies. And so again, if you are investing, if you're only buying term insurance and investing the rest in the market, and you outlive your term insurance, again, you will never be able to buy more. You will never be able to out earn the amount of death benefit that you could purchase through a policy based on whatever level you're at. So if you're thinking generational wealth, the value of that death benefit should be something that is at the top of your list. And so if you outlive your term policy and you're only banking on your investments for everything, right? Then that's just not a safe place. That's not a safe place to be in when you're a senior citizen and you need retirement income, or when it's time for you to leave that legacy to the next generation. Yeah, potentially your investments could take you there, but you would still never be able to purchase the amount of death benefit that you could purchase. So what if you had a convertible term policy, and before the policy, the term 10, 20, or 30-year term expires? What if you could roll that over into a whole life? What if you could, right? And or if you're buying a whole life policy just for the saving strategy that we're talking about, then you want to make up the difference in your death benefit, then that's another time to consider it. So either you can't afford the whole life, but you need to have some protection. So you get a convertible term. Or you're purchasing whole life as your saving strategy, so you're not going to have a lot of death benefit there. And then you want to make up for the amount of death benefit based on your human life value, which is typically 20 to 30 years of your income is what your death benefit should look like, right? So we'll continue that. We'll go deeper into that term life and human life value in another video. All right. So final expense insurance, like when is that the right option? If you're a senior citizen, 45 years old to 85 years old, you have no health insurance, no life insurance at all, and you need some protection, well, that's what this is for. This is to make sure you have some protection so that your children or whoever you're leaving behind, they're not going to be stuck paying for your funeral expenses and whatever debts you leave behind. You can have some minimal death benefit, and there's guaranteed issue policies without any medical exam for senior citizens who just need to have that little bit of insurance to protect their family, right? Then there's the business use we talked about. Businesses, you can use insurance, whole life insurance, saving strategy for key person insurance. It could be to protect a buy-sell agreement. It could be for succession planning, executive benefits, asset protection, employee benefits, estate tax planning, as well as collateral for loans. So many uses. Retirement income we talked about, estate planning, so whole life insurance is going to give you access to do all of these things while you're continuing to invest your money in your business and in your other strategies. And this is the hierarchy of financial needs, Maslow's hierarchy of financial needs. Did a video on this a couple months ago, and it just kind of talks about everyone's, all of us human beings having the same basic needs, and then going through the same processes to reach our pinnacle or our full potential, right? So we all have the same basic needs for food, housing, and transportation and daily expenses. Once we've met those needs, then we want to have some protection, some kind of emergency fund and insurance in place. Then we want to start accumulating wealth. Then we want to have financial freedom where we have flexibility to go and do what we want to do without having to owe anybody or ask anybody. And then we want to have the ability to leave a legacy. This is just a natural evolution of every human being. And Maslow was a financial analyst and scientist, basically, that did studies and researched hundreds of extremely successful people, including Albert Einstein and other successful people of that time, and realized that we all of us as human beings have the same basic fundamental needs and will progress naturally through this pyramid, through this hierarchy of financial needs. And again, with your whole life saving strategy at the bottom, or as your foundational of your financial strategy for your emergency fund and for your opportunity fund, it's going to provide you with all of these the tools you need. It is the tool that will be there and will grow with you and give you that flexibility and control that you need as you go through the different phases of the financial hierarchy of financial needs. So I hope I explained that well. That's it. So if you have questions and you want to schedule a call, you can do that. And that's not a sales call. That's just if you want to talk, you have questions about it, you can schedule a clarity call. At the very top of the site, if you wanted to actually see an illustration, then use the link at the top of the site. These links are going to be in the description of the video here of this live stream. And so if you want to see an illustration, that's one link. That's a longer session, about 45 minutes to an hour. We'll connect on a Zoom session to do that. And if you want to connect just for a Q&A, without looking at an illustration, but you just have some questions and you want to talk about the strategy or any of the things that I discuss on the channel, then please use the link in the description below to do that. That was a lot said. It looks like we are about, how long are we into this stream now? Let's see. I do not see it. About 40 minutes in. All right. And I saw that a couple people came in and out. I got a couple likes. Thank you so much for joining, those who jumped in and made those likes. For those of you that are going to watch this on the replay, please share the video. Please like. Please subscribe. And I definitely look forward to next Monday. We're going to continue this conversation. We'll go a little bit more into some of the other content as far as the other features of whole life and of term and some of the other ways that it can be used. I'm definitely looking to get some feedback in the form of comments and questions. So please post your comments. If you enjoyed the video, you could just let me know that. But more importantly, I want to get some feedback from you. So please let me know what you think or what your questions are. And I'd love to respond to that on my next video, on my next live stream, which is going to be next Monday, same time, same place at 2 p.m. Eastern Standard Time. Thank you again. God bless you. Have a wonderful week and take great care.